The recent banking crisis in the US has sharpened people's focus on the makeup of the US banking system and the FDIC's deposit guarantee that sits behind them. It's also prompted Australians to look a little closer at the Aussie setup too. For newcomers, the FDIC is the Federal Deposit Insurance Corporation and, quote, is an independent agency created by the Congress to maintain stability and public confidence in the nation's financial system. The FDIC insures deposits, examines and supervises financial institutions for safety, soundness, and consumer protection, makes large and complex financial institutions resolvable, and manages receiverships, end quote, from their website. The equivalent in Australia is APRA, who manage our own Financial Claims Scheme, FCS, which, quote, is an Australian government scheme that provides protection to deposit holders with Australian incorporated banks, building societies and credit unions, known as Authorised Deposit-Taking Institutions or ADIs, and general insurance policy holders and claimants in the unlikely event that one of these financial institutions fails. The FCS is a government-backed safety net for deposits of up to $250,000 per account holder per ADI. It also covers most general insurance policies for claims up to $5,000, with claims above $5,000 eligible if they fulfill certain criteria. Once activated by the Australian Government, the FCS is administered by the Australian Prudential Regulation Authority, APRA, end quote, from their website. Part of the sharpened focus is looking under the hood of these US banks. Like Australia, the US is very heavily weighted into just a few banks. However, unlike Australia, the US has literally thousands of smaller banks, all covered by the FDIC. 4,124 of them to be exact. It's a moving target. The following chart may be considered a cause for concern, particularly in the light of it predating the smaller bank run crisis. As alarming as it is for just 4 banks to be holding that much, over $9 trillion of the US's wealth, what is more alarming is how much of it is not insured. The total of deposits in all US banks above the $250,000 guarantee limit was a staggering $7.7 trillion as of 31st of December 2022. Of that, 3.286 trillion uninsured deposits, 43% of the total, are in just those 4 banks. Again, that is at a date well before the crisis that saw a run of withdrawals, many above $250,000, from small banks to larger ones. Now consider this statement from the FDIC. Quote, following the 2008 to 2013 banking crisis, the reliance by the US banking system on uninsured deposits grew dramatically, both in dollar volume and as a proportion of overall deposit funding. From year-end 2009 through year-end 2022, uninsured domestic deposits at FDIC institutions increased at an annualized rate of 9.8% from $2.3 trillion to $7.7 trillion, end quote. Let's pause and put that $7.7 trillion into perspective. It is nearly 1/3 of all USD GDP, the total of all its outputs. It is more than the already ludicrous deficits of the US government for the past 3 years combined. Digressing a little, but you can't unsee the chart shown now as an insight into the bigger problem here. Bank runs, as we saw just weeks ago, get a momentum of their own regardless of guarantees and other measures. The US has allowed the uninsured bank deposits to more than triple since the last banking crisis, the GFC. The offset of this banking risk for depositors, who are unsecured creditors to the bank, was interest payments. With the inverted yield curve, the banks can't pay a decent interest rate, and so the depositors are leaving to seek higher yields in bonds and capital growth in gold, the latter with no risk whatsoever. Or they are leaving small banks for large banks in the belief they are somehow safer despite the above clearly spelt out uninsured deposit concentration risk. In Australia, we have a triple threat of not only the same $250,000 limit per ADI, but additionally banks being part of the same ADI. For example, Westpac and St George and Bank of Melbourne and Bank of South Australia are all the same ADI, so only $250,000 in total, and also a cap of $20 billion per ADI. Australia's own Financial Stability Board revealed the following bombshell. Quote, "The limit of $20 billion per ADI would not be sufficient to cover the protected deposits of any of the four major banks, even though their assets would ultimately be sold to fund any depositor reimbursements if the FCS was used in the resolution process. In any event, there could be circumstances in which these banks would be deemed to be too big to undergo payout and liquidation." End quote. Many do not realize how close the majors came to the brink in the GFC. Kevin Rudd, in his book The PM Years, recounted, quote, "We were particularly worried about 3 Australian banks, 2 second tier, 1 first tier, as we developed a range of contingency plans to prevent the collapse." End quote. Indeed, it was the US Federal Reserve itself that came to the rescue of Australian banks, with $4.5 billion loaned to National Australia Bank and $1.09 billion loaned to Westpac just in that 2008-2009 period. Since then, we have had our Parliament quietly bring into law the so-called bail-in provisions, as we have shared here repeatedly, the original now with nearly 300,000 views. These are all, in theory, low probability events, but as with our article posted on Monday on the US debt ceiling debacle, and again refer that earlier deficit chart to see how they got there, even at a 4% probability, the impact of that low probability event is so absolutely catastrophic, it begs why you wouldn't insure against it. And again, as we showed in Monday's article, the performance of your boring insurance of gold has been the best performing asset this century. Balance your wealth in an unbalanced world and consider the 5,000-year-old, no counterparty risk, hard asset that has seen all of this come and go before: gold. Thanks for watching. Please like, share, and subscribe, and balance your wealth at ainsliebullion.com.au.